Having a successful financial plan is more than just choosing the right investments, as we know. It requires a coordinated strategy that helps you build wealth, protect what you've earned, minimize taxes, prepare for retirement, and create a lasting legacy. Every comprehensive financial plan should address these 6 essential areas that I'll go over today, and we're just going to have a lot of great content. So I'm really looking forward to this topic today, and if there's anything I miss, I'm sure Roshan will fill in the gaps.
I definitely will. I just want to give a little bit of background on this. So recently, Adrian and I were asked to speak to a group of professionals on how to build a foundation, and we just thought it would be a great episode as well to share. And that speaking event is for young professionals, but I'll tell you, this is not an age thing. It's where you are financially. I've helped people in their 50s that were just starting out. I think of a couple clients that come to mind that were, post divorce, mid to late 50s, and essentially starting from scratch, building their financial foundation. And, 15 plus years later, they were actually able to build a good, healthy retirement for them. Actually, now I think of 4 people off the top of my head that have done so. So, though we talk about that, as I said, event was for young professionals, this is for anybody for building a foundation. And if you've built your financial foundation, there are always areas to refine and improve. There's slight tweaks you can do to improve the situation. Adrian, what's the first item you've got for us?
Yeah, so the first area we're going to talk about are just some general principles. So the first one I have on my list is an emergency fund. This is where you can save 3 to 6 months of essential living expenses, but whatever your comfort level is or your risk tolerance is, that really just determines how much excess savings you want to have on hand for, like I mentioned, emergencies. And sometimes it's best to keep these funds in a high yield savings account or a money market fund. Yes, it's used for an emergency, but if you have a lot of money in your emergency savings, you want to make sure you're getting paid just to sit on it, because hopefully you'll never have to use it. But having emergency fund on hand is extremely important, because the last thing you want to do in emergency is start pulling money that you set aside for retirement, education, or some type of goal that you have in the future. So putting an emergency fund in a high yield savings account offers you liquidity, financial security, and also gives you a little bit of return on your money.
Yep. And Adrian, you may have this up ahead, or you may have just assumed this was already done, but did you have eliminate consumer debt, credit card debt on your list?
Yep, that's another subcategory that I have under general principles. This is a big one, Paying off debt based on interest rate as well can sometimes be a bigger priority than the balance.
Yeah, and I only mention that with the with building that 3 month cash reserves, because very often it goes hand in hand, right? So what happens is people need to eliminate any consumer debt they have, get rid of that, and build cash. Normally, if you have consumer debt, it's because you didn't have the cash available. So a common mistake we'll see people make is they'll focus all their cash flow just to eliminate the consumer debt while ignoring the emergency fund. And then what happens is an emergency happens, a car breaks down, something comes up, and you've got to use that credit card again to pay for it because you didn't build the emergency fund. So the solution to this, and the term I like to use is breaking the debt cycle, is to make sure you build your emergency fund while paying down that consumer debt. If you've been lucky enough to not have any consumer debt, that's great. You can go straight to your emergency fund. But if you have some, I would say, even though the math will not make sense from an interest rate perspective, you'll always earn less in your money market than you'll pay in your credit cards. What you're trying to do is break the habit of using the credit cards and being your own financing firm, in terms of if there's an emergency, you've got your money available to pay it. I'm not saying don't use credit cards. What I am saying is make sure you pay them off every month. And if there is a balance, build your cash and pay off cards simultaneously so that when you eliminate that balance, it's gone permanently.
Yep, exactly. Understand what those interest rates are. A priority could be credit cards, personal loan, auto loans, anything that could have a very high rate. That's something that you want to start and paying off, because, a guaranteed 20% credit card interest cost, it's nearly impossible to outperform consistently through investing. So that's why that's a really good general principle for you to attack those credit cards or those personal loans or any type of liability that you have that has a high interest rate, so you can really start putting yourself in a better position financially.
Actually, I want to highlight something that you said when you compared the interest rate performance. You said it's very hard to outperform a 20% interest rate. That, I'm sure it's coming up with you building your investment account, but this will also show you why this is priority one, right? Building your cash reserves and paying off credit card debt, and then going into the investment step, as Adrian mentioned, due to the performance numbers.
Exactly. So I have two more items under general principle. The next one is improving your credit score. This is, how paying off bills on time, keeping your credit card utilization below 30%, and avoiding any, credit inquiries as well that can impact your score. This is a good one, just to help you get better rates in the future and put yourself in a position, which is the last one under general principles, saving up for a down payment on a home.
Yes, yep, that is definitely an important one as well. Making sure that you build enough so that you can purchase that home. If people talk about how difficult it is now, one of the most difficult times, how affordability is harder now in order being able to afford to buy a new property than it has been historically. So it's very important to build that cash, and remember that emergency fund is for emergencies and opportunities that may arise. I bring that up because if you ideally you don't want to use it fully to purchase that new home. However, it is something you can use if you need help with the down payment money. You've got that emergency fund you can tap into to use as well. Another thing to note on a new home purchase, oftentimes people will take whatever they have to get into that first home in terms of a down payment. You've got to think about other expenses as well along with that new home, moving costs, furnishing the property, window treatments, things like that that just come up that, as prior to getting my first home, I was not aware of these things. I guess I did see some of it with clients, but having the experience myself of just the greater expenses, usually utility bills are higher too when you make that move. So there's just a lot of additional pieces you've got to think about when you're buying that property. So cash is important.
Yeah, cash is very important. And a good way to maybe aim for or set a goal is maybe aim for that, 20% down payment, because that's a good way for you to avoid private mortgage insurance, which is an additional cost on top of everything else Roshan just outlined. You could, sometimes maybe run a comparison table, see what it looked like if you put as little as you can down, or 5%, 10%, 15%, whatever it may be, and see what that monthly mortgage cost would be and what it would be with private mortgage insurance and what it'd be without. So really understanding what the monthly mortgage payment would be, what private mortgage insurance could cost you, and also look at what the total interest paid over the life of the loan is. That's something too that could really fuel the decision on how much you want to save and how much you want to put down for the property.
All very good points. We have an episode. If we'll try to look it up and see if we can find the episode number, but focused on purchasing a property, and that's something we can help with a future episode as well about the nuances with that home purchase.
So we're going to move on to the second area I have on creating a strong financial foundation. And I call this one protect what you built. When you're building wealth, we know it's very important, but protecting it can just be as crucial. So this is where we look at insurance, whether it's life insurance, disability, long-term care, medical. This is all stuff that may come up in conversation or something that you would want to look into more as you progress in your career and your asset level starts to build up. So the first one I'll tackle, life insurance, understanding the difference between term life, whole life, universal life, variable life. These are all important for you to run the comparison to see which ones fit your need, and discuss when each type may be appropriate based on your individual needs or your financial goals. So this could be a big one, and depending on what stage you are in your career or your life, is something too where you should run the numbers to see what the cost is.
That's for sure. Not only the cost in your stage of life, but anything else going on that would impact this need. We just talked about a home purchase. In addition to the home purchase, have a child, that could be another reason for the need for life insurance. If neither of those two things have happened, but you have a spouse that maybe recently lost or left their job, that would be another area where you might have a change in your insurance needs, like life insurance. So it's definitely important to know the different types, but also looking at your personal situation and see, what are your needs and what changes will give you a reason to revisit them.
Yeah, you're exactly right. And I got to imagine people's, comfort level and risk tolerance plays a big variable into what type of insurance they need, how much coverage they want to get, how much cost they want to take on as well. So understanding the different life insurances that are out there is really crucial. So the
Yep,
next one I
it
talked
is.
about was disability insurance. Your ability to earn income is often your greatest financial asset. So you need to discuss and understand, what kind of coverage limitations you may be getting through your employer. What type of own individual disability insurance do you need to supplement that if needed? And understanding income replacement needs. This is, again, a crucial one because, your income is your greatest financial asset. And understanding the risk that you take if you're not fully covered or the ones that you have in place is a good starting point as well.
Yeah, the analogy when I first started in the business that they would make is, imagine you had a machine in your basement that just kept spitting out money. And would you get insurance for that? And that's the analogy that was used for this type of thing, for the disability insurance.
Yeah, that's a good one. I never heard of that one, but it's a great example and it's an important one as well because, your income is what you fuels those general principles that I went over. If you don't have the right disability insurance in place, that could have you dipping into that emergency fund and that could get depleted right away. It could impact you saving for the down payment on your home. It could cause you to start using, credit cards or personal loans. So all this stuff you're going to really see start trending gets intertwined in a way. So the next insurance I have on my list is umbrella liability insurance. As your assets grow, so does your potential liability. Discuss when an umbrella coverage becomes appropriate, such as when your net worth exceeds the liability limits in your homeowners or your auto insurance policy, just so you're protected with some of those unknowns that may impact you in your daily life.
No, that is definitely for sure something to look at, especially. I know this episode we're gearing more towards building that foundation, but as your asset level increases, the need for that umbrella policy goes way up.
Yep, exactly right. So overall, just review coverages as major life events happen. That's what Roshan really talked about when we talked about this category. Review your insurance coverages whenever you experience marriage, divorce, birth of or adoption of a child, purchasing a home, career change, or retirement. Any major life event that happens, that's a really good time to you to review your insurance needs and see what makes sense for you.
Completely agree.
So the next area I have on building a strong financial foundation is save for retirement strategically. And this is going to be a big one in the episode because, again, this is where you can really start creating your wealth. And the sooner you get started, the better. And that can cause that compound interest and wealth creation over time. And not every retirement account provides the same value. So understanding that is also crucial. Prioritizing your savings to maximize long-term growth and tax advantages is very important. So I broke this down into steps if you're just getting started out or just wanting to review what's the best way to strategically save for retirement. So the first step I have on here, which is a great one, is capture the full employer match if you have that available through your job. Always contribute enough to receive the full employer 401k match. This is one of the highest guaranteed returns available. Wouldn't you agree, Roshan?
Yes, and as you were introducing this topic, I was thinking about what we said earlier. So at the very beginning, we talked about the emergency fund and building that cash reserve, eliminating that consumer debt, and doing that simultaneously, and really looking at as being the first priority. I would say this is an area where you can violate the rule a little bit. What I mean by that is, if you've got that consumer debt, you don't have an emergency fund, but you're offered this 401k match, this is a situation where you should still take advantage of the 401k match. And the reason for that is Adrian mentioned returns when he was saying with the credit cards, it's tough to beat. If you're paying a 20% rate on your credit card, it's tough to beat that rate with performance. Well, in this case, you're getting 100% return on your money. If you have a 401k match, if you put in a dollar, they typically match a dollar up to a certain percent. So we want to make sure that you get that free money that's available to you. So that's one of those situations where, and this does make me think about financial planning in general. We are giving general rules, but what we do is we build customized financial plans because there are situations where violating a general rule is something that you may want to do. And then we just run the numbers and compare the math along the lines of what to do with those rules.
Yeah, perfectly put, Roshan. So once you're getting that match, and I like how you said it, once you're getting that free money through your employer, that's where we could look at other areas to invest or other accounts to invest in. That's why I have step 2 as maximize a Roth IRA. Take advantage of the tax-free growth, tax-free qualified withdrawals, and the greater flexibility during retirement. A Roth IRA is always a very powerful wealth creation tool. There are income restrictions on it as well, so not everybody can be putting money in a Roth IRA. So while it's still available to you, you really need to take advantage of that, because if you lose that opportunity, that's where we need to get more creative and look at other avenues like backdoor Roths or Roth conversions, which can get very complex. But if it's available to you, max out that Roth IRA after the employer match.
Yes, I completely agree. Get that tax-free money built. And both of these things, the sooner the better. If you're listening to this a little later in life, get started. If you're younger and you don't have the cash flow or asset level to maximize these things, that's why Adrian's providing you an order that you should look at. But get that match if you can, even if it's just a little bit of money into that Roth IRA, get it in there to build that tax-free growth in your, if you're building your career, you're early in. As your income goes up, eventually you won't be able to contribute to a Roth IRA. So you want to make sure you get that money in as soon as you can.
Yep, exactly right. So you're getting that employer match, you're maxing out the Roth IRA. So for step 3, and I know this will probably be up to some debate right now, because this is where, some people would say, oh no, that's wrong, or oh, that's completely right. So the step 3 I have is go back to the 401k and max it out. Increase the contributions, because, more money you're putting in the 401k, it's lowering your taxable income. You're building retirement savings fast, and you're potentially reducing your tax bracket, which is also helpful. So you are saving some money on taxes, and that's why I have that as step 3.
Yeah, and I think the argument you said people will make, don't do this or that, to me, that's where the customized financial plan comes into play. Because if you're the alternative, and Adrian, tell me if you have something else on your list, but to me it's, so step 1, get the 401k to the match. Step 2, maximize the Roth IRA. Step 3, you had mentioned 401k. The only alternative I would think of, once again, depending on goals, would be a regular investment account. And
Exactly, because of the flexibility.
yeah, and that's when the goals come into play. And the other thing, goal wise, if you're planning for education for children, maybe a 529 is something you look at for the state tax, getting a state tax deduction depending on where you live. So that third step could be controversial, and people arguing any of those other investments, or investment account, 401k, 529, et cetera, whatever they're arguing, could be correct depending on the individual personal situation and
Yep,
goals.
yep, exactly. And then one thing I'll also mention as well, I've been getting a lot of questions about this year, is when to put money in a health savings account. So that would definitely be step 4 or 5. One of the great things about a health savings account, it's the triple tax advantage, where, you save money on taxes when you put money in, it grows tax free, and you can take money out of it tax free for qualified medical expenses or health expenses as well. So that's also on the list. I want to make sure, I touch on that, because that could be a powerful type of savings account for you, depending on what your situation is.
Yep, I completely agree.
So we are going to move on to area number 4, which is Make taxes part of your financial plan. I feel like we've already been talking about this so far on the episode. Taxes are often one of the largest lifetime expenses you'll face. Making tax planning an essential part of your financial plan is crucial. Understanding account types. Know the difference between a tax deferred account, which is like the 401k account that we talked about, tax free accounts, which is the Roth IRA we talked about, and taxable investment accounts, which is the brokerage account. Each one of those are a great way to build wealth, but they all have different tax consequences that you should be aware of, because if you're strategic about it early enough, you can save yourself a lot of money on taxes, and who doesn't want to do that?
And people oftentimes will say, I've got an accountant, so I've got the tax thing covered. That's a very common misconception. You've really got to plan for your taxes if you want to minimize your tax liability. Once you get to the accountant with your information, it's too late. If you just think about it from a calendar perspective, your taxes are due April 15th the following year. So as an example, we're in year 2026 right now. April 15th, 2027 are when your taxes due. Well, once the calendar has changed, once it's January 1st, 2027, a lot of what you can do to manage your taxes, that opportunity is gone. So you've got to do a lot of the managing in the calendar year, which is typically prior to when you go to the accountant. So tax planning is a very important area to focus on.
Yep. And also asset location. Place investments in the accounts where they are the most tax efficient. An example would be having maybe bonds and tax deferred accounts, because we know bonds pay out interest. And if you have bonds all in your, brokerage account, they could be throwing off a lot of interest that would be taxable, where in a tax deferred account, it can be a little bit more efficient. You can avoid those, interest rate payouts. Keeping growth investments and Roth IRA accounts is also a smart way to save and be more tax efficient. This is like stocks, ETF, mutual funds that are concentrated in equities. This is a big one. Have those in your Roth IRA to take advantage of the growth. And when you take money out, it's tax free. I mean, this one's very crucial. Let's just say we take this back to what we're talking about in the middle of the podcast, where it's important. Put money in a Roth IRA. Good, you're putting money in the Roth IRA. But if it's just sitting in cash, you're really losing the value of a Roth IRA. You have to be strategic and invested. I've definitely seen it before where people are like, yeah, I put money in the Roth IRA. That's conventional wisdom. Everybody's telling me to do that. But you can't have it just sitting in cash, Take advantage of the tax-free growth it gives you. And the third one I have is tax-efficient funds and taxable brokerage accounts. A lot of things that are getting buzz online and on social media are low-cost index funds. Having them in a taxable brokerage accounts can sometimes be very tax efficient.
Yeah, even going a step better, even individual stocks in that taxable account, right? That can be even more tax
Yes.
efficient, because within the fund they'll make adjustments that will cause you to have a tax liability, whereas the stocks, you get to make those decisions. So yeah, tax efficiency is definitely important. Adrian mentioned seeing people with cash in their Roth. I think of a story where I had a client come in. We were just meeting each other. They'd been working at their company for 20 to 30 years. I can't remember the exact time frame. And when I asked how their retirement account was set up, they had said, we're not sure, whatever it was when I first joined. And it was just in essentially a money market fund for the last 30 years. 20 to 30 years. So that money literally could have been worth 3 to 4 times what the balance was if it was invested properly, versus just filling out a form at orientation and then never looking back.
Wow. Yeah. I mean, you see it all the time. And that's why, we're talking about it today. Check your accounts, see how they're invested, and see if there's any adjustments you can make that help you save on taxes. So the last little tax piece I have on here is tax loss harvesting. Use investment losses strategically. Turn a loss into something positive, like offsetting capital gains or reducing your taxable income. Be strategic about it. See what makes sense first. We always like the investment decision before the tax decision. Once you go through that, see if there's ways that you can save money for taxes by using those losses.
And I want to highlight what you just said. The investment decision comes first. Always make the sound investment decision first. And if it means you've got to sell something because the fundamentals or the story has changed and that'll cause a taxable gain, so be it. and then just pay the tax, right? Better to have the gain than to have that position reverse and end up losing money.
Exactly right. So, our fifth area that we're going to talk about on building a strong financial foundation is one of Roshan's favorite: invest with a purpose. Every investment should have a purpose and align with your financial goals. Define your goals. Ask yourself, what are you investing for? Is it retirement, purchasing a home, education, leaving a legacy? Defining what the goal is a very great way to understand how you should invest and where you should invest.
Yeah, and the one area we talked about earlier that could be somewhat controversial as far as where to save, it's just dependent on what that goal is. So build that, know what your goals are, and build your plan to help get you on the way to accomplish them.
Yep, exactly right. And determine your time horizon. Your investment strategy should reflect when you'll need the money. You should also know your risk tolerance. So build the portfolio that matches both your financial goals, your comfort with the market volatility, and your time frame. This is very crucial because we know with stocks, especially equities, markets can go up and down. And you don't want to have to sell at the bottom of the market because you need the money for something. So understanding how much time you have for investing is very crucial, because if that's too risky for you, you have a short time frame, that's where you have to look more at cash and bond. That's where it could be really, really crucial. So understanding the role of stocks and bonds and cash is very vital. You need to understand your time horizon and risk tolerance because that influences what you invest in your overall portfolio allocation.
And I'll give you a quick story about this with someone who I worked with after the fact. But there was this one client that I met in, I think it was 2001, and it was a couple. Spouse managed one spouse managed the investment accounts for years. The other spouse would go to parties and hear about all his friends making money in the tech bubble. Took over management, dumped it all into tech right before the market crashed, and he went from about to retire to working another 15 years roughly. And it was just because that time frame you mentioned and goals. If you're about to retire, you should not have all your money in tech stocks, right? Probably too risky for most. Maybe there's some that would be okay for. And I wonder if he knew the consequences. If he knew that, yeah, he's making less money than all his friends, but he could retire versus trying to make what his friends are making and then having to work for another 15 years. Right. I think had he planned that out, I don't think he would have made the change.
Exactly right. And maybe if he understood the value of diversification as well, that could have also helped him out. Reduce risk by diversifying across asset classes, stocks, bonds, cash. With equities, look not only domestically in the US, but international markets. When it comes to stocks, look at large companies, mid cap companies, small companies, and overall different sectors of the economy. Like that example that you just gave, Roshan, that client was concentrated heavily in technology. Well, there's more sectors and industries than just technology. There's healthcare, financial, energy, staples, consumer, discretionary, you name it. Diversifying across those sectors can help overall improve the volatility and the losses that you experience within the portfolio. So, properly diversified investment portfolio can help you preserve and grow your wealth over time, and also, more importantly, beat inflation.
Yeah, exactly right. Consistently, right? It can consistently improve the situation versus getting really risky at one time and ending up really hurting the overall situation.
And the last kind of subcategory I have under invest with purpose is rebalancing. Periodically rebalance your portfolio to maintain your desired asset allocation and risk level, because you may have a very good year with the stocks and equity portion of your portfolio. And then the year after, another great year. And all of a sudden, a lot of your wealth is concentrated in equities, maybe in a certain sector or industry. And if that has a negative year next, or just there's market volatility that causes it to go down, it can have a negative impact. So have a rebalancing strategy in place is very crucial as well to help your assets promote the type of investing that you want to do.
Yeah, and I've done multiple analysis and reviewed multiple scenarios, and in general, rebalancing is ideal in the 18 to 24 month time frame. However, based on volatility of your portfolio in the markets, you may want to do it a lot more frequently. David Swenson is the person who he managed Yale's endowment fund, and he really made the endowment style of investing popular, and they would rebalance daily. Right. So probably overkill for the typical investor to rebalance daily. However, it does help manage and manage market volatility. What we like to do is, yes, we have that rule of thumb of 18 to 24 months in mind, but we also look at what's going on with the market and the volatility that has happened, how much things have moved. And we've had years where we've done multiple rebalances within a 2 3 month time frame because of the volatility that was taking place.
Yeah, and I think just to add on to that as well, maybe probably one of the most common things that people face that really shows the importance of rebalancing is, let's just say you started off early in your career investing in a retirement account or 401k, and you're like, I'm just gonna invest it all in stocks. And then you work at that company, for 30 plus years, and all your money's like going into stocks and you're close to retirement. All of a sudden you have this built up big savings in your 401k all in stocks, which is great, and you're planning on retiring soon. With market volatility and markets going down, that could significantly impact you right before your retirement. This is where rebalancing really could have saved you in that situation.
Yeah, for sure. And, especially if it's concentrated in that company stock. That's some of the horror stories from Enron. And if you are a younger listener, you probably haven't heard of it, but Enron, the company went under. And there were a lot of employees in the company that had their entire 401k in Enron stock. So what happened to them was they lost their income because the company went under, and then they lost their savings because the company went under and they had it all in their stock.
Yeah, that reminds me of a similar story I heard too about like the 2008 financial crisis, where a lot of people at that time, like you mentioned, were, not only getting paid great salaries, but they were also accepting their salary a lot in company stock as well. And during the 2008 crisis, a lot of stocks got impacted. So that negatively impacted people's retirement. That's where diversification, rebalancing is very crucial and very real and very important.
Yes, completely agree.
So we are going to move on to the last area I have on my list on building a strong financial foundation. And this is estate planning. Protect your legacy. Estate planning is about ensuring your wishes are carried out while protecting the people you care about the most. Roshan and I, we're not lawyers. We can't give legal advice, but what we're talking about is very crucial and has a very significant impact in your financial plan. With everything that we've talked about, seek out a professional, but a big one that we always see is review your beneficiary designation. Certain accounts that you have, like IRAs, even bank accounts, 401ks, whatever type of financial account it is, it more than likely can have a beneficiary on it. So when any major life events happen, review your beneficiaries, because that sometimes can supersede some estate documents that you have in place.
It does. Like if you've got, there's another real life story is we had met someone years ago who beneficiary was an old boyfriend versus the current husband. So if she had passed away, her husband would have been pretty mad if her old boyfriend got her entire 401k balance. Right.
And it's
So
more
make
common than you think too, because you may get to a point where you're just juggling a lot of different accounts. Again, you might have a 401k, a Roth IRA, a brokerage account, bank accounts, and it's a lot of accounts to deal with. So this is a good starting place when it comes to estate planning. Just review the beneficiaries on the accounts.
and
And
most
then
people don't, right? That's part of the issue when you mention it's more common than you think. Most people set it up when they set up the account and then never look at it again.
exactly right. So also, it's good to mention everyone should look at and consider having a basic will that outlines asset distribution, guardians for minor children, executor selection. These are all very crucial foundational pieces that you need when it comes to estate planning, because you want to make sure the wealth that you build up goes to whoever you want. You want to make sure if you have kids, the right people take care of them. And overall, the right people are fulfilling the wishes that you outlined in your will. Those are all key areas. Other estate documents as well, financial power of attorney allows someone you trust to manage your financial affairs if you become incapacitated. Healthcare power of attorney and advanced health medical directive. This designates someone to make healthcare decisions on your behalf if you're unable to do so.
Yeah, Adrian, I think there's a lot covered today. That was the last area, correct? The estate planning.
Yeah, and the last subcategory I have is trust planning. Explain when trusts may be beneficial and see when that is a good part for you to start looking into creating, because we know trusts avoid probate, protecting beneficiaries. It helps you maintain privacy. There are certain ways that sometimes you can save money on taxes, and especially if you are part of a blended family or you have a complex family situation, trust can be very vital on protecting your assets and fulfilling your wishes when it comes to this type of need.
Yep, it's a way to control the assets once you passed away. So I completely
Yeah,
agree.
so overall, again, my final takeaway is a successful financial plan isn't built around a single investment or a financial product. It's built by making thoughtful decisions across every area of your financial life. These comprehensive financial plans should address the 6 areas that I talked about today, those general principles: protecting what you built through insurance, saving for retirement strategically, don't forget about taxes, make taxes part of your financial plan, invest with purpose, and protect your legacy through estate planning. So when these 6 areas are working together, they create a financial plan that's designed to help you build wealth, manage risk, and reduce taxes, prepare you for retirement, and confidently pass your legacy on to future generations. We always say at the end of the podcast, take control and achieve your goals. Well, this episode's perfect on taking control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.